Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Normally, I'd say it's 1 o'clock on the East Coast, but it ain't 1 o'clock anywhere. It's 9:35 a.m. East Coast time. EYT from SoFi. How are you, Elizabeth?
I am well. Thank you for being patient through my technological difficulties today.
Yes, Elizabeth was impaling herself with technology. Dan's sporting somebody just said Dan in the merch. What does that mean?
Merch. Merch is
swag.
for
you guys all have them.
them.
By the way, Liz wears hers to the gym. Guy, yours is in the bottom of your closet, but whatever, man. We still, by the way, just a little housekeeping. We say that often when we have an announcement, but we also have a bunch of risk reversal swag that we'd like to give away. So, we'll just do that thing. Leave a review in the podcast store, take a screenshot of it, send it to Amanda, contact@riskreversal.com, and you'll get like a t-shirt or a hat or something like that. Let's clear that stuff out by the end of the year.
Do it today, by the way. Just blow up. What do they call it when you blow up somebody's inbox?
He calls it blowing up the inbox.
Yeah, we'll do that to Amanda today. But it is market call early on this Thanksgiving Eve. A lot to go through. We're going to try to keep it tidy. So welcome, everybody. Dan, what sticks out to you? I know what sticks out to me. We had some pretty high, interesting, high-level earnings last night that didn't work out all that well.
Yeah, no doubt. But before we do that, Liz, why don't you get us going with the Fed's most favored inflation reading, because that's one that just gets listen, the data this morning between PCE and GDP are kind of a big part of this whole story in 2025, right? So I know that you've been writing about both. I'm sure in your outlook for 2025, these are going to be huge focus. What do you take out of these two prints this morning? And you can go with whatever you think is more important.
Yeah, well, honestly, let's start with the Fed minutes. So the Fed minutes yesterday came out and they talked about being basically the sentiment moved more dovish. So it sounded like they were more dovish, but they said something along the lines of, but we're going to be more gradual with our rate cuts. So what that tells everybody, also they're talking about reducing the repo rate by just 5 basis points, a very tiny amount, but reducing it nonetheless, which is where the dovish commentary sort of came from. But these gradual rate cuts. So what we're hearing from the Fed is we're still going to cut rates, but we're going to be very careful and data dependent about it. And I think that that's fine. What happened today? So we had some GDP revisions. I put a tweet out. That's what I was trying to bring up for everybody. I put a tweet out. There was a lot of econ data today, and I think it's interesting to just pay attention to everything that's going on. I mean, we focus so much on things like PCE, but we had a GDP revision. There we go. We had a GDP revision that brought GDP up by 0.1 percentage point. So this initial jobless claims number, this is something that, Guy, I think we should talk about just a little bit. Initial claims on a seasonal basis, and I will give Mario a lot of credit on this. He said to me about a month and a half ago, I think what's going to happen in fall is initial claims are going to come down because of some weird measurement and seasonal factors, but it might be a head fake. And you know what? They have come down. They have surprised on the downside every single time, and he has been exactly right. But if you go to that next chart, we're looking at continuing claims moving in the opposite direction. And this is actually the more important data that you want to look at in these high frequency data dumps from the labor market. Continuing claims are people that have been unemployed for a longer period of time. This continues to move up. This is actually what I think the Fed watches more closely, and it's still sending some alarm bells. So I'm going to pause there, Guy, give some feedback on the labor market.
And that's the one. I mean, first of all, congrats to Mario, and I said his name correctly because he was spot on in his prognostications this summer. With that said, this is one you have to look at, because if you go back over the last now couple of years, these are the highest levels we've seen in quite some time. And to me, Elizabeth, this suggests that unemployment rate at some point is going to start catching up on the back end of this. So it's just a matter of time. And quite frankly, this is exactly what the Federal Reserve wants. Let's not confuse the issue here. I mean, they want this thing to move in this type of fashion. They also want it to stop at a certain point. The rub is, I think, can they get it to stop, or the way you and I talk about it is going to hit this sort of terminal velocity where it gets to a point where it doesn't stop and it gets to levels where they're not happy with. And that's really I think what the market should be focused on.
Yeah, the only thing I'll just say about that, guys, is that, I think the Fed has reached some sort of equilibrium. That's what Fed Chair Powell has been saying us. Remember, like earlier in the year when they kind of had that focus shift from, too hot of an economy to supporting the labor market, right? And they were ready to start cutting rates, and then maybe not because inflation. And it just feels like so the whole idea of unemployment rate meaningfully going higher would really be, it's not consistent with a 2.8% GDP, right? Like that's the only issue.
Well, that's not necessarily true, but I hear you.
Well, tell me what. So tell. You know what I mean? Like it sounds like the economy is in pretty decent shape. That's what I mean. So what is the condition that would cause unemployment to go meaningfully higher if companies actually start seeing, I don't know, like margin compression and the geographic issues and inputs from inflation start picking up and the economy starts to slow because all of that. But again, I mean, it doesn't really appear to be the case right now.
No, it doesn't appear to be. Okay, ahead, Liz, because you know this stuff.
Well, here's the thing. So the bull case, and actually I would subscribe to this bull case a little bit. If you look into 2025, as we all know very well, we've been talking about this for 2 years. Our concern has been, the three of us, our concern has been that margin compression would start to happen because of inflation, because input costs were going to go up. Employment costs were pretty high as the labor market was tight, and that at some point that was going to take a big bite out of earnings. That has happened a little bit in the sense that margins have come down, but they came down from a record high level. So there was room for that compression to take place. And I don't have a chart of this ready to go, but if you look at a chart of basically S&P profit margins, the way that they've been trending, they're right back down at the normal trend line. So still in a healthy place. Into 2025, if we have the expectation for what we call low labor churn, meaning people aren't quitting their jobs, people aren't getting laid off, they're staying in their jobs. So there's not a decrease in productivity because of churn. And then you've got just the idea that we have government spending continuing, not necessarily stimulus, but spending in the sense of still supporting aggregate demand, supporting companies in being able to spend on CapEx and invest in the business. So there shouldn't be a huge hit to productivity in 2025, which then means there shouldn't be a huge hit to margins in 2025. So it's possible that we don't have this shock to the upside in unemployment, at least not yet, which I think is still what the bulls are saying. And actually, I would say it hasn't shown its face yet. So let's not keep anticipating something that could go terribly wrong. But you do want to watch these indicators like continuing claims because they tell a different story. And I talk about this all the time with relationship problems. If continuing claims are telling a different story than initial claims, you have to scratch your head. The same goes for things like the VIX, right? When the VIX is down, if that's sending a different story than other things happening in the equity market, you got to scratch your head. One of them's probably wrong in the short term.
And it's interesting, you look at the GDP. I mean, it's all basically consumption if you look at where the numbers are coming from. And if you start then, okay, what's the consumption? The consumption's on the high end. And how do you know that? Well, look at what William Sonoma said, for example. That's cherry picking, but that's anecdotal of what's going on. The flip side of that coin is look how shitty the dollar stores are and look at the problems like a Target has. And then look at basically the pull down to places like Walmart and Costco. Then you start to connect the dots and say, all right, I see what's going on here. The high end is spending like, they're partying like they've never partied before, which sort of makes sense. I mean, they seemingly are the best suited to take advantage of this wealth effect. It all makes sense. The lower end is getting crushed and the middle's getting squeezed. So the GDP, you can make an argument that the GDP is what it is based on the higher end, and that below the surface, there could be some damage being done in the labor market. So, that could be, maybe not, but that's sort of the way I look at it here, Dan.
Yeah. All right. So then the other thing I'll just say, so we're talking about margins and the like, and we're definitely promised you people, we're going to get to some single stocks and some stuff like that. We don't want to get too bogged down in the macro, but it was a big macro day. You also have the 10-year at 4.25. Okay. And so Liz just said that, the Fed minutes read dovish, right? You have crude oil below 70. It can't get out of its own way, right? Let's kind of look here. What's the average, gallon of gas at the pump right now? I know that it topped out at like $5 or something like that. Is right, Liz, over the last year and a half or so.
Yeah.
We've been drawing that line. So, I mean, it's basically in October, the average price at the pump for a gallon of gas in the US was $3.14. You know what I mean? That is really important as it relates to that lower end consumer, right? And so I guess what, Liz, you just said, look at Diaz. She is just Johnny on the
She
spot.
is. She had her coffee today.
You said like and I'm just using that because you just used it before. We've spent the last couple of years trying to kind of pick apart a lot of this. I'm just sick of it. I'm just going to tell you that. And, I am sick of it because every turn and twist and this and that, whatever, it just defies logic. And, that first week of August felt horrible. It felt like we were going to be into something. You know what I mean? Like it was going to be the start of something. And then I kind of go back, and I started in the business in 1997, and I didn't know jack shit about anything that was going on, okay, about markets, about the interrelation with the macro and this, that. All I knew is that a bunch of 4-letter stocks in the NASDAQ that were supposed to be the next big thing were moving around like crazy, and people were getting shit rich trading them, right? And so I was at a hedge fund, and they told me, go figure out what XCIT, YHOO, AOL, AMZN, all these things, what they BRCK or whatever broadcast was. And I went and I tried to figure it out. The S&P from 95 to 99, that's 95, 96, 97, 98, 99, average like 25% returns for 5 consecutive years. Now, there were some, there's some fits and starts. There was long-term capital. There was a, currency crisis or whatever. So I don't know, could you make that same assumption right now that maybe generative AI, as it works itself into other industries, you know what I mean? Not just kind of the ones that it's most focused on, hyperscalers and chips right now. Maybe that's the thing that's supportive of a 22, 23, 24 S&P multiple. I'm throwing it out there because you were in the markets back then too. And everyone was scratching their heads and trying to pick apart a lot of things. And there were reasons. Like long-term capital, people thought that was going to be like, that was like the precursor to the financial crisis. That was some scary shit.
Yeah. Well, I mean, the bull case is that this market can support these types of valuations, given everything you just said. I mean, if you go at historical norms, we're a few standard deviations away where we should be, but people will say it's different this time. That's what you hear over and over again. It's this different paradigm shift, and we're in this new type of economy. And that very might be the case, and maybe we're going to start having to look at things a little bit differently. I believe, though, things usually mean revert. You talk about that all the time. And as much as people want to say it's different this time, the only thing different is the names. I mean, the narratives are pretty much the same. And if you go through history, these cycles happen in different industries, but they're always this paradigm shift. It's always different this time, and it winds up never being different this time. So this has obviously lasted a lot longer than I thought it would, and there's still things out there that are concerning. But the market right now in this world of passive investing where money flows in, I mean, it's all systems go until it's not. And I don't really know what that is, because now with the VIX below 14, to Liz's earlier point, I mean, people are saying, you know what? There's really no boogeymen out there for the foreseeable future. And we're just going to throw sort of caution to the wind. The president-elect is seemingly putting people in that are more moderate than I think the market probably anticipated, which is not necessarily a bad thing. And I think that's what the market is taking its cues from.
Yeah. Really
hold on. A couple of things. One thing that I'd want to point out. So when you think about it's not different this time. I agree with that. I mean, I like breakout in hives whenever people say it's different this time. It's just the time frame maybe is different.
Mm-hmm.
And the problem with it is, if let's say this lasts for 4 years, or what Dan said, 5 years, and we have 15 to 25% up in the S&P every year, that's a lot longer than I think any of us are expecting it to last. And frankly, a lot longer than most people are expecting it to last. Just look at the Strategist price targets that have come out for next year. Everybody's expecting more muted returns than what we've seen in 23 and 24. So most of those targets only suggest about a 10 to 13% upside in the S&P from here, which is more muted, above average, but more muted. So when you think about just the length of time that it might take, that's how you end up looking wrong in the medium term, right? And maybe it is supportive of some of those valuations. AI can be supportive of that in the medium to longer term. But I think what's going to happen in 25, and this part of this will be in my outlook, is that it's not going to happen from the same sector. So Dan, to your point, if AI is the engine that we need in order to drive productivity, support these higher valuations, keep the market churning out good returns on a broad basis, it probably starts to rotate into other sectors, right? We go from semis into software. Maybe healthcare starts to see some of that upside. Maybe industrial start to see more of that upside, right? We probably don't have another year where a sector like utilities is leading all the way through August. And some of these little head fakes that we've had along the way, the regional banking crisis was one of them, where I think many of us thought, uh-oh, that's going to do it. And then we had this yen thing and we thought, uh-oh, that's going to do it. But the sentiment and the enthusiasm and this sort of long-term AI fixes most things mentality has allowed us to get through a lot of those bumps and bruises. And I think that sentiment is still strong enough to keep that going. Now, we could have bigger shocks, but I still think that there's enough buying appetite in the market. And I don't think we're as extended as we were in the late 90s. So people are screaming, oh my gosh, this is so obviously overdone.
Yeah, well, there's a huge difference, okay, between the 90s and here. And guys, I'm not trying to change a narrative that I've been on for a year. Okay, what I'm trying to do is understand the psychology of investors who are going to literally peg the S&P to the all-time highs, by year end, right? And then if you look at those returns, we could have an S&P at 6150, and then all those folks that are up there on that screen are going to be, rejiggering those 6500s, those 6600s. So you can say, well, it looks like modest expected gains, but we know that strategists trip over each other, right, to raise them. All right. So as they get affected by price. So that's one thing. What's different, and this is matter of fact, is that the stocks that were driving, the upside, and it was Microsoft, it was Dell, but it was also, Nortel and Cisco and this or whatever. These companies that are driving it right now are so dominant. They are so profitable. They throw out so much cash. If the AI thing ends up being too, over capacity and this or whatever, could Microsoft, should Nvidia, could these stocks lose 30% easily? They've already done it here and there, right? Nvidia lost 30% or whatever, but I don't think I don't know. I just think that's an important difference. The other difference I would make is that why does Walmart trade at 33 times earnings? Why is Walmart up 75% on the year? Walmart is not a small market cap, right? We can all agree on that. And so, Guy, you brought this up a bunch over the last couple months since their last earnings when you're seeing e-commerce acceleration. So investors are willing to pay 33 times for this retailer, right? And this is a $750 billion market cap company that's gained 75% this year, right? It looks like it should be in the category of the Nvidias. It's massively outperformed Microsoft and Google and Amazon, that sort of thing. So, that's the only thing I just want to, I'm not trying to change a narrative that I've been on for a while. I'm just trying to understand the psychology of it. And these are the biggest stocks in the biggest market around the world, and they seem to be, at least hanging in there for the most part. But last thing I'll just say, Walmart's had this leg higher. What is that? From 85 to what? 91.5, as Nvidia guy has gone from 145 to 130 or something like that. That says something about what's going on in the market. Is that fair to say?
I think it is interesting. It's noteworthy that, your point about Walmart is well taken. We've talked about Walmart for a while. The Nvidia one is interesting to me because, again, this is eerily reminiscent, Nvidia, real quick, of what we saw back in March and what we saw back in June 20th or so. And then obviously you had earnings last Wednesday, I believe. You saw the subsequent move the next day to make a new all-time high, closed around the lows, and we've been trading lower ever since. I mean, we've talked about the setup here for a number of times. I mean, it appears as though if you want to draw an uptrend from the August low, that uptrend is going to come right in around where the 150-day moving average is-ish. And, that's really where this thing should trade down to and find support. So probably around 125-ish or there, or maybe a little bit higher.
130.
So, I mean, you see the support. The support is, as Carter says all the time, comes in the form of the moving average. But you have to ask yourself, are we setting up for what we saw in March, what we saw in June, and then potentially the same type of broader market move we saw on the back end of it?
Yeah. Hey, while we're looking at the Nvidia, I think this is important. So it's down today. A lot of tech is down today, but Dell, let's go to Dell for a second. It's down 12%. This is one that I think you and I were both pretty skeptical of into the print, especially because of the rally that it had, but also because some of the things that we've been hearing, right, out of some of the other folks in this ecosystem. And so, what they said last night on their earnings call was that, there's still a lot of demand for their servers that go into the data centers, right? And so, but the problem here is that they're talking about some capacity constraints. They're talking about Blackwell, which is NVIDIA, their next generation GPU, some of the, fits and starts that they've had. They've talked about some of the costs of implementing that new chip and all the technology in and around it. And so you had NVIDIA last week on their earnings kind of suggest this a little bit. And NVIDIA, was up, it was down, it closed flat on the day, but then it started going lower over the next few days. And then you get this data point a week later from Dell, and you say to yourself, well, maybe it's not a straight, line higher. You know what I mean? And so I think this is important, guy. You've highlighted Micron. We've highlighted Super Micro, which is a competitor of Dell. So Micron is obviously the storage. You've talked about the sideways action in Microsoft. Microsoft acts horrible if you think about it relative to the NASDAQ and where it is. So, I know this goes against what I was just saying on that little kind of rant before. I guess there's going to be other sectors that have to kind of pick up the baton a little bit because these ones might kind of chill out a little bit. Does that make sense?
Yeah, no, it makes sense. But the problem is those other sectors are not nearly as big, so they can pick up the baton, but they're going to be able to carry the weight that these obviously these mega cap tech stocks have. And in terms of Dell, I mean, if you want to throw that chart up real quick, we had a conversation yesterday. Given the run that it had off the recent low, we didn't think the setup was particularly good. I mean, the stock almost doubled from that August 5th low or thereabouts. So it didn't make a lot of sense in terms of being able to sort of build on those gains. And, they talked about it, I'm paraphrasing to a certain extent, but they said, it's going to be sort of nonlinear over the next couple of years in terms of their performance. So if they're going to be nonlinear in terms of their performance, the stock should be nonlinear as well. So in other words, it shouldn't be lower left, upper right. So this makes sense. Now, the question you have to ask yourself is, is there an entry point? And maybe it comes in the form of sort of the 50% retracement of this recent move, probably around 105-ish, 110. And here we are now, I think, where are we trading right now, Dan? About 125. So I think there's some more downside room, but it's clear that we've breached the 150-day moving average. It's also clear that that's flattening out. If this were to show continued weakness, then you're going to have to say maybe that August 5th low is in play, and then you have to wonder what it means for the rest of the space.
Yeah. Hey, Liz, really quickly to Guy's point about passing the baton. I made the point, and then he basically just said, it's you guys know the argument we've been making again. So if an NVIDIA is down 11% now from its recent highs a couple of weeks ago, and NVIDIA was basically 25% of the S&P 500's gains year to date, which is pretty insane. And, we remember from June 20th down to the lows on August 5th, and maybe that low wasn't particularly a real one, but it basically legitimately lost 30%. Right. And this is a $3.1 trillion market cap company. Can you lose some of these big guys? Like next year, the idea that NVIDIA would be up 175% is just nearly impossible, right? You'd have to have the sort of beat and raises that you had in 2023, which is not going to happen, right? We can just all agree on that. So I guess the question is, can the market continue to go higher? 2,6,500, 2,6,600, 2,6,700 without these folks, because the banks are raging here. There's a few sectors that act pretty well, but they don't make up, the earnings power of 10, tech stocks.
Well, I think that's the math of it. And that's a lot of why a lot of these strategist price targets are lower next year, because even if the expectation is something like financials takes over or software takes over, they're not big enough. They don't have as much earnings power. They don't contribute as much to the fundamentals of the S&P to take us up at the same trajectory that these other large cap tech companies have. So do they have the power to take us up 10%? Yes, but it has to be more than one sector. So the returns can't be as concentrated as they've been. You also need these big tech names to still hang in there, right? You can't have them completely fall off a cliff and expect the market to still produce 10 to 15% returns, because mathematically, that's probably going to be really, really tough to do unless you've got a sector like financials that's going to rip and give us 100% next year, which I think is highly unlikely. So when you look at just some of the math of this, I think it's important. And if we can pull up a chart of IGV. I know we've looked at this one so many times, but we've talked about semiconductors ad nauseum. And then you've got this tech software piece that has seen a really good rip now. But look at how the space between, what is it, a 200-day moving average, 150 days. Yeah. The space between that moving average and where this industry group is trading right now, makes me nervous because
Mhm.
typically you have to retrace some of that before you can really find a more durable leg upward. And there's a gap there to fill, right? So you have to be questioning, is this a good entry point in some of this stuff that I think is still going to do well in 2025? I think you have to watch these. And we talked about this a little bit on the tape on Monday, is that it's not that you're trying to call just one entry point, especially when things have run so far. If you want to initiate a position, initiate it, that's fine, but do this gradually because you might get more opportunities. And a lot of this post-Trump trade is still based on proposals, not actuality. So we could still see a decent amount of volatility in some of these groups that are really sensitive to policy in 25.
What's interesting here, by the way, we got a question. This sort of dovetails nicely in terms of sectors. This is from Chris E, and he asked it to Liz, but Dan and I are equipped as well. Will XLV outperform from here, or do you like other sectors too? So if you look at the components of the XLV, I think the first one is Eli Lilly. I think that's the highest one, and then it sort of goes down from there. I sort of look at this and say, you know what? It's been hanging around pretty well, despite the fact that Eli Lilly sort of got whacked recently. So it's Lilly at 12%, UNH at about 10, J&J 7, AbbVie and Merck sort of rounded up. So yesterday we heard that President Biden would love for, I guess, Medicare and Medicaid. I've never really understood the difference, to pay for these GLP-1s. They got to bounce on that. If Amanda real quick can pull up an Eli Lilly chart, you'll see we traded down to the levels that we held back in this spring around 725 or so. So I don't know. Maybe the XLV sort of is interesting here. It's been hanging around despite the fact that Eli Lilly's been crushed over the last month and a half, 2 months. And I think, Dan, that healthcare can still be a place to go, regardless of who's in office or who's not in office.
Yeah, I would almost want to look at the IBB. So that's the the biotech ETF, and Amgen is a big part of that. Amgen's had a rough go of late, and you could say that there might be some headwinds to some of these stories, right, that got a bit more mature. But Guy, you've been talking about the potential for M&A in and around the GLP-1 space. If you think about Amgen, for instance, if Amgen got nailed because they're not getting the sort of results that some folks think that they're going to get a product to market for GLP-1s, look at that. It did trade really well off the lows yesterday. Maybe Amanda can give us a 2-3 day chart, and you can see the gap. Look at that. The gap lower, it was what, 265 or something like that, and closed 280. Pretty interesting price action, but maybe that's one, Liz, that could be kind of interesting. This is not the name individually because of the idiosyncratic risk, but maybe the IBB because of the potential for deregulation and deals like this and their ability to get done.
Well, it's possible that whoever asked that question watches Halftime Report, because last Thursday I used XLV as my final trade. And there was a report very shortly after that from Jonathan Krinsky, who's a technical analyst, that healthcare was looking oversold and this could be a good entry point. So it's one of the few places in the market right now that it doesn't necessarily mean that I see a ton of upside in 2025. Not like I think this is going to produce 75% returns in 25, but there's so much bad news baked in here with the Kennedy nomination. All of it is sort of in these stocks right now, and the expectation of them not getting out of their own way for the next at least 12 months. So when you look at something like this, you've got a ton of bad news baked in, and we don't know the outcome yet of that healthcare secretary piece. If that changes, you're going to see a repricing in this sector. So Dan, to your point, if you're looking at just biotech, here's broadly what I think is going to happen in 25 is we've seen obviously a ton of growth in semiconductors. Investors are going to start to look to other parts of the market for growth. And healthcare is historically a defensive sector, particularly in the large cap space, except for biotech and pharma. That's a more growthy part of healthcare. But if you move down the market cap spectrum, even more growthy. So you could even see some good growth in the mid and small cap sections of healthcare if you're looking at biotech and pharma.
Yeah, and got one more question. Oh, go ahead.
Yeah, let me make a point here because you just mentioned semis. Maybe Amanda can pull up the SMH for a second. And this kind of goes back to what Dell was saying last night. They said there's still really good demand, although it's not going to be linear, as kind of Guy mentioned on the kind of AI front, the server front. But we heard that PCs are not doing great. right? So the whole idea of these kind of co-pilot, these AI enabled PCs, like you got to push that thing out a little bit. And so that's also something we heard from ASML a few weeks ago when that stock got nailed. They make, equipment to make chips. They were talking about some of the end markets like PCs not doing particularly well, are smartphones, which leads me, this is a question, Guy, from Dan N. First time, long time. I never miss the market call. Apple seems to be a bit of an outlier in this whole generative AI story because it's really hung in there very near its all-time highs, consolidating a bit. So, and maybe I'll just, Dan N, you sound like a wicked smart guy. I'm sure you're pretty good looking and you have tremendous acumen in the stock market. So the Apple thing sticks out like a sore thumb because A, they didn't spend a lot on creating and training the models. They put something on a device that was really, in my opinion, just smoke and mirrors. I mean, it's literally like putting lipstick on a pig as far as the strategy. The stock had been massively underperforming until that June 10th WWDC where they announced Apple Intelligence, and the phone is worse with Apple Intelligence. I'm just going to tell you that. I have the 16. It's really nothing going on there. So the question I guess you're trying to get to is why does this stock hang in there when we see the SMH acting very poorly other than a handful of stocks, but they're starting to kind of sell off a little bit. The hyperscalers seem to be going sideways to lower, just if you look at Microsoft. So Guy Adami, maybe you can help Dan in. Why is this stock hanging in here relative to everything else that's going on in technology right now?
I wish I could answer that. I mean, it always seems to be in benign market environments. Apple wins to passive investing. I think they're in, I want to say 300 and something ETFs, of which, they're one of the top 10 holdings or so. So, in benign market environments, Apple's just going to sort of levitate just on the back of money flows. I think that's part of it. So you've seen what happens on downdrafts. I mean, Apple's not impervious to that. And I think to a certain extent, we're seeing it now. But, if valuation's ever going to start to matter again, I think they're going to matter in the form of Apple. And although Warren Buffett is selling Apple more of a portfolio thing than anything else, I mean, he has been paring down positions. And I think you have to take that in consideration as well. So, historically, we do go back and revisit the 150-day moving average. I think it's going to happen again. I don't know when that's going to be. You can see these tops that we've been creating here since July. I guess it's 245 or so. I don't know what the prior all-time high was, but something around there. And, we'll see if it blows through or if we just sort of start to do it back and fill at some point. Real quick, Dan, before we 5,000, PCE just came out. I would submit it's probably not what the Fed wanted to hear, but it doesn't matter what I think. I know Elizabeth has some thoughts on this.
Yeah, this just came across at 10 o'clock. What we got earlier today was the quarterly PCE report. That's part of GDP, which is less important because it's so backward looking. This is the monthly one that everybody watches. Everything came in pretty much in line with expectations, but higher than last month. And that's how the market is interpreting this. So I've been trying to watch bond yields as this was going on. The 2-year yield was down for the day, still is down, but gave back some of that move. So you saw actually a deeper now reinversion of the yield curve. We're inverted about 3 basis points. We started the day at about 1 basis point. So if we're re-entering this environment where the yield curve goes back inverted, we've got concerns over inflation, we've got a Fed that sort of pauses or gets perhaps jawboned into not cutting too much. This could be a really, really interesting start to 25.
Dan, Nathan?
Yeah, I mean, I just find the move from 4.5 to 4.25 interesting in the 10-year, except for the fact that it was probably more interesting that the 10-year went down to 3.6 and then started rallying once we got the first rate cut in 3 years or so. So I think the outlook for rates is about as clear as mud right now. So that's why we're going to continue to watch some of these inflation readings. Liz, when's CPI? Is that in? It's kind of like the second.
It's always about somewhere around the 10th of the following month. So
yeah, and listen,
December 10th, 11th.
I think you guys are spot on by keeping a close eye on that continuing claims, and they come out every week, right? Because
every Thursday.
yeah, I mean, like, if you start to see movement, I get it. And I didn't mean to, I'm not pushing back for the sake of pushing back. I told you, I'm a little tired of just kind of trying to look at things, half empty versus half full. And that might be my New Year's resolution there a little bit. So who knows? All right, I'll leave it to you guys here. You guys had nothing on the Dan N question. I mean, I kind of went for it, and I didn't
What
even
was
see
the Dan
smirk.
N question?
What did we do? What?
It was about Apple. I said, you probably, a great looking guy. You have tremendous market acumen. The Dan N was me. I asked.
We were just so focused on the question.
Yeah,
I mean,
Liz and I are trying to lock in here,
By the way, Liz,
we're trying to work, Dan.
Liz, guy doesn't do cute. Okay, like he doesn't do cute at all. Like if it's not coming, if it's not sharp and straight and to the point, he doesn't want it. You're not there for that guy.
Yeah, no, cute is one thing I've never been, but
no, I don't mean you, but like when someone tries to be cute, you know what I mean?
Yeah, no, it doesn't. It's false. Typically, it lands flat.
By the way, last night, without naming a name, I was out with a woman who is a fabulous podcaster. She's not in our space, but she does a lot of TV, and she wouldn't shut up with just the two of us at dinner about how funny Guy Adami is. She kept on going and going. I think she drops in and watches our show maybe a couple times a week, that sort of thing. The Fast Money. How funny he is.
She must be a brilliant mind.
And you know what I said? Like, funny, ha. Does he amuse you? That was my response. But I don't know. What do I know?
It's the smart, as Bill Hockman. We should get Bill on one day and do a podcast with him. The funniest people tend to be the smartest people. I'll just sort of leave it at that.
Bill,
right? What do you think, Elizabeth?
By
the way, do the Packers of Green Bay play on Thanksgiving Day?
This is a question. I don't think they play on Thanksgiving Day.
I don't think they do. I know the Lions of Detroit play. I don't know if the Packers of Green Bay play.
The line again for the Bears is -10. I think they're probably going to beat them by 31.
Lions are legit.
All right, you want to know the games tomorrow?
Well, they do play. They do play on Thanksgiving Day, 8:20 p.m.
Who are they playing?
A classic
rivalry.
The
Dolphins.
Oh, wow. The fish in Green Bay. I love that.
Guy, so let me ask you this. This is actually really interesting because Dallas, after 3 straight losses, they go into Washington that had 2 straight losses, and they kind of beat the pants off them. And Dallas, they don't have Dak and this and that, whatever. What do you think of that game?
So the game, the last game, or this giant game, the Dallas Washington game?
Yeah, no, Dallas Giants. You're New York Football Giants.
So the Giants seemingly have now mailing it in. It appears as though they want their coach to be summarily dismissed. You can tell when, as in the NFL, they say guys start making business decisions. That basically means, you know what? And if there's a chance that they're going to hurt themselves, they're not going to sort of put all out effort. And that's what I'm seeing on the football field with the Giants. So unless I'm completely off base, the Giants will be summarily, as a word I used before, dismissed by the hated Cowboys of Green Bay. The game to watch, though, as Elizabeth just said, is the resurgent Dolphins with Tua at quarterback going to Green Bay. The weather's probably going to be cold, is my sense. We'll see how the fish handle the elements and the frozen tundra of Green Bay.
Yeah, warm weather teams don't tend to do well at Lambeau. And I mean, the Packers are 8-3. We're on a good streak. Yeah. Momentum is high. People love a holiday game. We'll be watching it.
As it turns out, before we get out of here, the problem with the Packers wasn't the Packers. It was their head coach who sucks and one quarterback named Aaron Rodgers who also sucks. That's it.
I don't mind our head coach.
No, the ex-head coach, Mike McCarthy.
Oh, Mike McCarthy. Yeah, he's not there anymore.
They're ready to run him out of Dallas too. Liz, I kind of smell that apple crumble pie in the background there. It sounds like
it's not. I've got the crust out, but after this, I'm going to get it started.
All right, you go get to work, Guy. I'm sure you're stuffing turkeys all afternoon.
Yeah, sure.
Yeah, sure. I'm out of here. I'm going to see my parents up in the Great White North of Syracuse, New York. So I'm going to be on the road this afternoon. Guy, you guys hosting? You guys host a big crew, don't you?
We'll have some peeps over. It's not going to be as robust a turnout as we usually get, but it'll be a nice day regardless. I think it's going to rain here in the Northeast. So I'm going to throw a little bah humbug at you people. For all you parade goers, bring your umbrellas.
Are you going, Liz? You're going to the parade?
Uh-huh.
Yeah.
I mean, we live pretty close to it. We're taking the kiddo.
Oh, that's awesome. That's
It's gonna
fun.
be wet and cold.
Little housekeeping before we get out of here. OTT, that would be the On the Tape podcast, is going to drop Friday morning. It's Guy, Danny, myself. We're going to kind of do a little bit the week that was and look ahead at December and what we're thinking here. Liz, you're going to be back with us on the On the Tape podcast Monday morning. That'll drop in the afternoon. We're going to be back on Market Call next week, Monday, Tuesday, Wednesday, Thursday. Guy, you see what I did there?
Like Apollonia.
Yeah, like Apollonia. And I will say that I did that to my wife yesterday, Sarah, and she actually got it. Like she got it. And
She gets it. She's
that's
no
old school.
dope.
That's some old school stuff. All right, Guy, you want to take us out?
Happy Thanksgiving. Listen, all kidding aside, thanks for being with us. A lot of you folks every single day. We appreciate it. We're thankful for you. Have a great holiday with your family and friends. We will be back on Monday. Till then, Dan, hasta la vista, baby.
Yeah, everyone. Thank you.